to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. China's latest economic data presents a paradox. On the surface, many indicators suggest the economy has stabilized. Employment has improved, industrial production is gradually recovering, exports remain resilient, and policymakers continue to provide monetary support. Yet beneath these encouraging headlines, consumer confidence remains fragile, household spending is uneven, and the property market continues to weigh on long-term growth. The central question is no longer whether China is recovering. The more important question is whether that recovery rests on a durable foundation. Throughout today's report, we'll examine China's liquidity conditions, inflation trends, industrial activity, domestic consumption, external trade, and market sentiment to understand why stronger employment data may actually be masking deeper structural weaknesses. Trend overview. Inflation provides another window into China's evolving recovery. The blue line shows consumer prices, while the red line tracks producer prices. Producer prices have rebounded sharply from deep deflation and are now moving into positive territory. This reflects improving industrial demand, firmer commodity prices, and gradual stabilization across manufacturing sectors. Consumer inflation, however, remains remarkably subdued. Normally, producer price inflation eventually feeds into consumer prices as companies pass higher costs along to households. This time, the transmission mechanism remains unusually weak. The explanation lies in domestic demand. Businesses may be facing rising input costs, but competitive pressures remain intense. Companies often absorb higher costs themselves, rather than risk losing customers through price increases. Weak household purchasing power limits pricing power throughout the economy. This divergence between improving producer prices and subdued consumer inflation reinforces our broader conclusion. Supply-side conditions are stabilizing faster than household demand. Rebar steel production and inventory growth. Turning to industrial activity, rebar steel offers valuable insight into China's construction sector. Production growth has remained volatile, while inventory levels have also fluctuated significantly throughout the past year. Rebar is closely tied to property development and infrastructure construction. The recent data suggest infrastructure activity continues to provide support, but real estate demand remains considerably weaker. Production has recovered intermittently, yet inventory accumulation indicates demand has not consistently kept pace with supply. In other words, construction activity has stabilized, but it has not entered a sustained expansion. This aligns closely with our assessment that public investment continues supporting growth, while the private property sector remains a major structural drag. Medium and heavy plate production and asphalt plant operating rate growth. A more encouraging picture emerges when examining infrastructure-related indicators. Medium and heavy steel plate production has remained relatively resilient, while asphalt plant operating rates experienced solid gains before moderating more recently. Asphalt demand serves as an excellent proxy for road construction and public infrastructure investment. Unlike residential property development, infrastructure spending remains one of Beijing's preferred policy tools because it supports employment without significantly inflating housing speculation. These data suggest infrastructure continues acting as an important stabilizer within China's economy. However, infrastructure alone cannot replace household consumption as the primary engine of long-term growth. Government investment can build roads and bridges, but ultimately consumers must generate sustainable demand. Cold-rolled steel coil production and inventory growth. Cold-rolled steel provides insight into manufacturing activity, particularly automobiles, appliances, and machinery. Production has remained relatively stable throughout the year, suggesting manufacturers continue operating at healthy levels. Inventory dynamics, however, remain considerably more volatile. Periods of inventory accumulation, followed by rapid drawdowns, indicate manufacturers remain cautious about future demand. Companies are willing to produce, but they continue adjusting inventories aggressively as market conditions evolve. This reflects a broader theme across China's manufacturing sector. Firms expect stabilization, but not yet a broad-based acceleration in domestic consumption. Production confidence has improved modestly. Sales confidence remains considerably more cautious. PTA operating rate and inventory days. Moving beyond heavy industry, this chart focuses on purified terephthalic acid, or PTA, one of the key upstream materials used in polyester production for textiles, packaging, and consumer goods. The dark blue line tracks plant operating rates, while the lighter blue line measures inventory days. One of the more encouraging developments is that operating rates remained relatively resilient for much of the period, indicating that manufacturers continued utilizing capacity despite an uncertain demand environment. Inventories have risen at times, but not to levels that suggest widespread overproduction. This tells us that manufacturers linked to consumer goods remain cautiously optimistic. They are continuing to produce, but they are doing so with careful inventory management rather than aggressive expansion. In many ways, PTA illustrates the broader state of China's manufacturing sector. Businesses are not preparing for another explosive growth cycle, but neither are they retreating. Instead, they are positioning themselves for a gradual recovery while remaining highly sensitive to shifts in consumer demand. That cautious optimism is consistent with the broader message emerging across high-frequency industrial indicators. Domestic consumption, logistics deliveries. Weekly parcel deliveries offer another valuable window into consumer behavior. The 2026 data began the year strongly before experiencing the normal Lunar New Year disruption. Activity then recovered quickly and has remained broadly above 2024 levels, while tracking closely with last year's performance. This suggests that online consumption remains relatively resilient. E-commerce continues to be one of China's strongest consumer sectors, supported by mature logistics infrastructure and increasingly efficient delivery networks. However, logistics data should be interpreted carefully. Strong parcel volumes do not necessarily imply strong household purchasing power. Consumers may simply be shifting spending toward online platforms while remaining cautious about overall discretionary expenditure. In other words, the composition of spending continues evolving even if total consumption remains subdued. The logistics sector therefore reflects adaptation rather than a full recovery. Aggregate consumption, automobile sales. Automobile sales provide perhaps the clearest measure of household willingness to make major purchases. Unlike everyday necessities, Buying a vehicle requires confidence in future income, employment stability, and household finances. The 2026 series remains noticeably weaker than previous years for much of the period, despite occasional weekly rebounds. Holiday promotions and manufacturer discounts continue generating temporary spikes in sales, but those gains have yet to evolve into a sustained upward trend. This reinforces one of our central conclusions. Consumers remain cautious when making large financial commitments. The labor market may be improving statistically, but households continue behaving conservatively because future income remains uncertain. When people lack confidence in tomorrow's paycheck, they postpone purchases that require long-term financial commitments. That explains why vehicle sales continue lagging despite improving employment data. Services consumption, movie box office. The services sector tells a similar story. Movie box office revenues experienced a strong seasonal boost during the Lunar New Year holiday, before quickly returning to relatively subdued levels. Even with more films being released and entertainment options expanding, sustained spending has remained limited. This illustrates an important principle. Supply alone cannot create demand. Consumers must first possess both the financial ability and the psychological willingness to spend. Entertainment spending is often one of the first categories households reduce during periods of uncertainty because it is entirely discretionary. The relatively soft box office performance therefore reinforces the broader picture emerging across retail activity. Chinese consumers are spending selectively rather than freely. China, growth in port cargo. Throughput. External demand continues providing one of the economy's strongest sources of support. China's port cargo throughput has remained remarkably resilient throughout the year. After the usual holiday slowdown, cargo volumes recovered quickly and have largely remained in line with or above recent historical performance. This demonstrates that global demand for Chinese exports remains healthy despite ongoing geopolitical uncertainty. Exports continue offsetting some of the weakness in domestic demand. For investors, this distinction is critical. China's economy increasingly resembles a two-speed recovery. External sectors tied to manufacturing and exports remain comparatively strong, while internally driven consumer sectors continue facing structural headwinds. Understanding that divergence is essential when evaluating investment opportunities across Chinese industries. China, export container, freight rate index. Freight rates provide another perspective on external trade. Both the China Export Container Freight Index and the Shanghai Export Container Freight Index have risen sharply in recent months. The increase reflects a combination of resilient export demand, shipping capacity constraints, and ongoing adjustments to global supply chains. Higher freight rates often indicate stronger demand for shipping services than available capacity. Shipping companies have responded by expanding routes, particularly toward North America and Europe. At the same time, geopolitical risks remain elevated. Developments involving the Middle East, trade negotiations, and broader geopolitical tensions all have the potential to disrupt global shipping routes. So far, however, China's export sector has demonstrated impressive resilience. External trade continues acting as one of the economy's most reliable growth engines. Airline capacity deployment shipping companies are not the only businesses responding to stronger trade activity. Airline cargo capacity has also adjusted significantly across major international routes. Capacity deployment increased meaningfully toward Southeast Asia and Europe while remaining relatively stable across several other regions. These adjustments reflect changing trade patterns rather than broad economic weakness. Transportation companies continuously allocate aircraft toward routes where demand is strongest, making capacity deployment an excellent real time indicator of global commerce. The data suggests businesses remain confident enough in international trade to continue expanding logistics networks. This supports our view that China's external sector remains fundamentally healthier than its domestic consumption story. Google Search Popularity Index and US Market Volatility Index. Our final chart shifts attention from China to global market psychology. The dark blue line measures Google search interest surrounding trade-related topics, while the volatility indices on the right axis capture financial market uncertainty. Historically, spikes in trade-related searches often coincide with periods of elevated market volatility. Investors naturally seek information whenever geopolitical tensions, tariffs, or trade negotiations become major market drivers. Recently, search activity has moderated alongside relatively contained volatility. Markets appear to have become increasingly accustomed to ongoing geopolitical uncertainty. That does not eliminate risk, but it does suggest investors are becoming more selective about which developments truly alter the economic outlook. For China, this creates both opportunities and challenges. Stable global markets support exports, but long-term domestic growth will ultimately depend less on external conditions and more on rebuilding household confidence. Employment has improved, liquidity has stabilized, industrial production continues recovering. Yet until households believe their incomes are secure enough to spend with confidence, China's consumer recovery is likely to remain gradual rather than explosive. Broad money, M2, cumulative growth versus fiscal expenditure. We begin with one of the most important macro relationships in China, the interaction between monetary expansion and fiscal policy. The dark blue line tracks cumulative growth in broad money, or M2, while the lighter blue line represents cumulative fiscal expenditure growth. Historically, these two series tend to move together because government spending and banking system liquidity reinforce one another. When fiscal spending accelerates, money creation usually follows. Likewise, when liquidity expands aggressively, government investment often becomes more effective. Today, however, both indicators have slowed substantially compared with previous stimulus cycles. M2 growth remains positive, but the pace of cumulative expansion has moderated. Fiscal expenditure has also become increasingly restrained throughout the first half of 2026. This tells us something important about Beijing's policy approach. Unlike previous downturns, policymakers have deliberately avoided launching another broad-based credit explosion. Instead, they have relied on targeted liquidity injections while maintaining relatively cautious fiscal spending. The result is an economy that has stabilized, but without the kind of overwhelming policy impulse that characterized earlier recoveries. Liquidity remains abundant, yet confidence has not fully returned. Money is available, but households and businesses remain hesitant to deploy it aggressively. This distinction between liquidity and confidence will become a recurring theme throughout today's presentation. Broad money, M2, progress. Looking at weekly progress throughout the year provides additional perspective. The dark blue line represents 2025, while a red dashed line tracks the current trajectory for 2026. At this stage of the year, money supply growth is broadly following last year's pace, with cumulative expansion progressing steadily toward historical norms. This reinforces the view that monetary conditions are no longer deteriorating. The People's Bank of China has successfully maintained ample liquidity, interbank funding pressures have eased, and financial markets have remained relatively stable. However, stabilizing liquidity should not be confused with accelerating credit demand. Think of monetary policy as opening the water valve. The central bank can ensure plenty of water reaches the pipes, but it cannot force households and businesses to turn on the faucet. If confidence remains weak, additional liquidity simply accumulates within the financial system rather than translating into stronger spending or investment. That is precisely what appears to be happening today. As we've seen throughout today's presentation, China's economy is no longer defined by a single headline or one monthly data release. Liquidity is abundant, industrial production is gradually improving, exports continue demonstrating resilience, and policymakers retain meaningful fiscal and monetary flexibility. Yet beneath those encouraging developments lies a more structural challenge. Employment is improving, but increasingly through flexible and gig-based work that provides less income certainty. That shift helps explain why consumers remain cautious despite lower unemployment. People do not spend confidently simply because they have a job. They spend confidently because they believe they will continue to have one. From our perspective, China's outlook is best described as stabilization rather than reacceleration. The economy continues moving away from cyclical volatility and toward a longer structural transition that will unfold over years, not quarters. Thank you for watching YCC Capital Macro Research. If you found this analysis valuable, subscribe to receive our daily macro research and in-depth investment insights. We look forward to seeing you in our next report.